Imagine being legally forced to spend $1.7 billion in exactly 10 seconds.
Oh, wow. Yeah, that's
Right. And you aren't allowed to negotiate. You aren't allowed to care what the price of the asset is. You just have to buy it blindly before a very specific clock strikes zero.
it sounds like a movie plot, honestly.
It really does, but that isn't some wild hypothetical scenario. That is the exact mathematical reality happening right beneath the surface of the S&P 500. If you've glanced at your portfolio or watched the financial news lately, you have probably noticed the S&P 500 hovering around this massive 7,000 psychological barrier this quarter.
Right, everyone is watching that 7,000 mark.
Exactly. But today, we aren't just going to look at that shiny number on the surface. We are going down into the basement.
We are looking at the hidden plumbing because beneath that daily headline number, there is a vast mechanical infrastructure moving trillions of dollars around. And it's completely indifferent to the daily news cycle or market sentiment.
And that is the mission for today's deep dive. We are talking about the high-stakes quarterly ritual known as the S&P 500 rebalance. We're going to unpack the rigid mechanics of this schedule, analyze the massive structural shifts happening right now in March 2026.
Which is a huge one, by the way.
Oh, absolutely massive. And we'll look back at the last two rebalances to see who won and lost, and finally reveal what top brokerages forecast for the rest of this year.
Okay, let's unpack this because I think a lot of people assume the S&P 500 is just, an automatic list.
Right, like a simple leaderboard.
Yeah, like you take the 500 biggest companies in America, you put them on a spreadsheet and you call it a day, but it's actually heavily managed behind closed doors.
It is entirely managed by a human committee at S&P Dow Jones Indices. I mean, they adhere to a very strict schedule, executing these rebalances on the third Friday of March, June, September, and December. Those 4 specific Fridays.
Exactly. Those 4 days are when the actual tectonic plates of the market shift. But to even get considered by this committee, a company has to survive a brutal gauntlet of gating criteria.
Right, the rules of the game. And the barrier to entry just got significantly higher, didn't it?
It did. As of July 2025, the committee bumped the minimum unadjusted market cap for entry all the way up to $22.7 billion.
Which is just staggering. And just to clarify that term for you listening, unadjusted market cap essentially means the raw total size of the company based on all its shares.
Yeah.
This is before anyone starts making complex adjustments for how many of those shares are actually floating around for the public to trade.
Yeah, the raw size.
So you have to be a $22.7 billion behemoth just to get to the front door. The size isn't enough.
No, not at all. They also need positive earnings for the most recent quarter, and the sum of the past 4 quarters has to be positive. Plus, you need to meet strict liquidity requirements.
Meaning your stock actually trades in high volumes every single day.
Right. You can't just be a big company on paper that nobody actually trades.
I like to think of the S&P 500 committee as this incredibly ruthless bouncer at an exclusive VIP club.
That's a great way to look at it.
Yeah, just because you have a lot of money, which is your high market cap, doesn't mean you automatically get in. You have to prove to the bouncer that you have staying power, which is your 4 quarters of positive earnings. And you have to prove you draw a good, consistent crowd, which is your liquidity.
If we connect this to the bigger picture, you see why that bouncer cannot afford to be lenient. I mean, the S&P 500 accounts for roughly 80% of the entire U.S. equity market capitalization.
80%.
Yeah, trillions of dollars in index funds, mutual funds, and institutional retirement accounts are tethered directly to this specific list of companies. So the committee's primary job isn't to pick the coolest new tech stock, it's to protect the benchmark.
Right, because the stakes are just too high.
Exactly. If they let a volatile, hyped-up company into the index solely because its stock price skyrocketed for a few weeks, and then that company inevitably collapsed, it would drag down the 401ks of millions of people. The rules are a firewall, really, to prevent a single volatile stock from crashing the broader economy's barometer.
So we know the rules of the club. But what actually happens when that velvet rope is finally lifted for a new company? Let's look at the financial impact, because this is where the market plumbing gets fascinating.
It gets really intense here.
It does. When a stock gets added, it triggers a mechanism called forced flow. I was reading through our sources, and the sheer scale of this is hard to wrap your head around.
Oh, the numbers are mind-boggling.
When a company joins the index, passive funds like the SPY or VOO ETFs literally do not have a choice. They are legally mandated by their prospectuses to track the index perfectly. That means they must buy the new stock by a fixed deadline.
It is a cargo train without brakes. Fundamentals do not matter in that exact moment. Only the math matter.
Break that math down for us.
Sure. To put the scale in perspective, let's say a newly added stock is given a tiny 0.10% weight in the index. Against a $1.7 trillion passive fund, that tiny fraction equates to $1.7 billion in forced demand.
Just for one fund.
Right. And that demand has to be executed over an incredibly short window, usually culminating in what's called the closing auction on that third Friday.
Okay, stop right there. The closing auction, I see this term thrown around in financial media all the time. But what is actually happening on the floor, or I guess in the servers, at that exact moment? Why does a $1.7 billion forced buy order cause so much chaos at the bell?
So the closing auction is the final trade of the day, occurring at exactly 4:00 p.m. Eastern. Rather than matching buyers and sellers one by one as they do all day, the exchange pulls together all the final buy and sell orders into one massive batch.
Oh, so it's all clumped together at the end.
Yes. They use an algorithm to find a single price that maximizes the number of shares that can be traded instantly. So, when passive index funds are forced to buy $1.7 billion of a new S&P 500 stock, they all dump their massive buy orders into this final closing auction.
Because they have to hit that exact closing price.
Exactly. They do it to ensure they get the exact closing price and minimize tracking error. You literally have billions of dollars blindly slamming into the market at the exact same second.
Which brings us to recent history. If we look at the last two major rebalances, September and December 2025, we saw this forced flow play out in real time.
September was wild.
It was the busiest rebalance in 4 years. They brought in AppLovin, Robinhood, and EM Core Group, and booted out MarketAxess, Caesars Entertainment, and Enphase Energy. That single event forced the reallocation of nearly $250 billion worth of stock.
It's a massive structural shift.
And then in December, they brought in CRH, Carvana, and Comfort Systems. But I have to push back here for a second. If I know that SPY and VOO are going to be forced to buy Carvana on a specific Friday, and S&P announces this days in advance, why can't I just buy Carvana on Tuesday and sell it to the ETFs at a markup on Friday? Isn't that just free money?
Well, you'd think so, right?
The sources note that this index effect, the pop a stock gets when it's added, used to average around 7.4% back in the 1990s. But recently, it's moderated to barely 1.0%. So is this strategy totally dead for the average retail investor?
Yeah, Wall Street algorithms have entirely eaten that arbitrage. I mean, the 1990s were a different era of manual trading and slower information dissemination. Today, the millisecond S&P issues that press release institutional algorithms read the text, calculate the forced flow, and reprice the stock.
Before a human can even blink.
Exactly. The overnight gap up essentially consumes all the profit before a retail investor can even open their brokerage app the next morning. But focusing purely on that overnight price pop misses the more profound long-term transformation. The real aha moment here isn't the quick profit. It is the permanent change in the stock's liquidity and trading identity.
How does the identity change? What does that actually look like for a retail investor who's been holding the stock for years?
So before a stock enters the S&P 500, it moves largely based on its own merits. If the company has a great earnings call, the stock goes up. If they launch a bad product, it goes down.
Makes sense. Normal market behavior.
Right. But once it joins the S&P 500, it becomes tethered to global macroeconomic currents. It gets deeper order books, tighter bid-ask spreads, and massive institutional ownership.
It gets dragged into the big leagues.
Yeah, and for the retail investor, this means your great company might suddenly see its stock plummet 5% in a day. Not because of anything the company did, but simply because the Federal Reserve hinted at an interest rate hike and global investors panic sold the broader S&P index.
I see.
The stock basically graduates from being an individual story to being a structural beam in the global financial system.
So if these passive funds are already acting like a runaway cargo train, forced to blind buy billions of dollars of a new stock, what happens when you force them to do that on the exact same day? Trillions of dollars in derivatives are expiring.
Oh, that's the perfect storm.
Because that is the collision we are watching right now in March 2026. This isn't just a standard quarterly swap. The effective date is Monday, March 23rd, which means the massive rebalance execution hits the market close on Friday, March 20th. And that specific Friday is triple witching.
Triple witching is an absolute volume crisis.
Break that down for us.
It is the simultaneous expiration of three things: Stock options, and index futures. You have trillions of dollars in derivative contracts expiring and settling on the exact same day that the S&P 500 is forcing index funds to mechanically buy and sell billions of dollars of stock.
That sounds incredibly volatile.
It is. The order books are flooded, creating an environment of extreme volume and intense price volatility heading into that 4:00 p.m. closing auction.
And the actual companies being swapped in the pipes during this March collision tell an incredible story. Here's where it gets really interesting.
I love looking at the specific names here.
Right. For the S&P 500, the additions are Vertiv, which builds massive industrial cooling systems for data centers. Then there's Lumentum, which specializes in optical networking, Coherent, and EchoStar.
Heavy infrastructure name.
Exactly. Meanwhile, the companies getting kicked to the curb include Match Group, the company behind dating apps like Tinder Molina Healthcare, Lamb Weston, and Paycom Software. And if you look at the S&P 100, which is the ultra-elite subset of the biggest megacaps, it's an even more dramatic shift.
Oh, the S&P 100 changes are telling.
They are booting out legacy, household names like Target, PayPal, and MetLife to make room for semiconductor fabrication giants, Micron, Lam Research, and Applied Materials. We are literally trading dating apps and department stores for data center cooling, optical networking, and semiconductor fabrication.
What you are witnessing is Wall Street mechanically crowning the AI industrial complex.
The AI industrial complex. I like that phrase.
It really fits. For the last couple of years, the artificial intelligence boom was largely about software narratives and the initial chip rush. But this specific rebalance proves that institutional money is moving past the software phase.
They're getting physical.
Exactly. They are locking into the physical, heavy-duty infrastructure required to actually keep AI running. You cannot run massive, power-hungry AI models without specialized optical networking to transfer the data, and you certainly cannot run them without immense industrial cooling systems to keep the servers from melting down.
Which is exactly what Vertiv provides.
Right. By hardwiring these physical infrastructure companies into the S&P 500, the index is cementing a structural shift.
Wait, isn't that incredibly dangerous? I mean, if the committee keeps purging consumer staples and software companies to constantly make room for AI hardware and chip makers, aren't they basically turning the safest index in the world into a highly concentrated, volatile tech fund?
That is the defining risk of our current market structure, actually. And it comes down to a concept called cap weighting.
Cap weighting.
Yeah. The S&P 500 isn't just 500 equal slices of a pie. It is weighted by market capitalization, meaning the biggest companies drive the bus. When a few massive tech and AI infrastructure companies grow to multi-trillion-dollar valuations, they consume a disproportionate percentage of the index.
So they have an outsized impact on everyone's portfolio.
Yes. If the AI sector suffers a drawdown, those heavyweights will drag the entire index down with them, regardless of how well the other 490 companies are performing. The broad diversification people expect from the S&P 500 is becoming much more concentrated in a single technological thesis.
It's like buying a ticket for a cruise ship and realizing halfway across the ocean that the engine room is taking up 40% of the entire boat.
That is a very accurate analogy.
But, you know, just because an AI hardware company makes it into this elite club doesn't mean it's safe forever. Because inclusion relies heavily on corporate governance, which brings us to the absolute elephant in the room right now. Supermicrocomputer, or SMCI?
Oh, man. The SMCI saga is a stark reminder that the committee's gating criteria are ironclad, and governance is just as important as market cap.
To give you listening the context, SMCI was the absolute darling of the market. It was the top-performing S&P 500 stock, riding the very AI hardware wave we just talked about. But their shares just crashed 33% in a single day.
Just a total collapse.
Why? Well, because federal prosecutors charged the co-founder and two others in a massive $2.5 billion smuggling scheme. They are accused of unlawfully redirecting banned advanced NVIDIA AI chips to China, completely breaching U.S. export control regulations.
It's a massive deal. And because of these severe governance and regulatory violations, our sources indicate SMCI is at a huge risk of being forcibly removed from the S&P 500 during the upcoming June rebalance.
It's like a professional sports contract with a morality clause.
Yeah.
You can be the MVP of the entire season, scoring the most points and bringing in the most revenue, but if you get caught orchestrating a federal smuggling ring, the league's going to void your contract. They'll kick you out of the stadium and pull someone off the bench to replace you.
What's fascinating here is that S&P removals are rarely due to sheer stock price drops alone.
Really?
Yeah, a stock can perform poorly for years and just slowly drift down the cap weightings. Sudden removals are almost always triggered by M&A activity, unexpected bankruptcy, or, as in SMCI's case, catastrophic governance failures that break the foundational eligibility criteria.
Because they need to protect the reputation of the index.
Exactly. The S&P index is meant to represent the highest quality, most reliable companies in America. A federal indictment for a multi-billion-dollar smuggling operation shatters that trust entirely.
So if SMCI gets pulled off the court, who comes off the bench? The rumor mill is already churning. Marvell Technology seems to be the prime candidate right now.
Marvell makes a lot of sense.
They boast a pristine $76 billion market cap, well above the $22.7 billion requirement, and they just reported $6 billion in data center revenue alone. Then you have retail favorites like SoFi, which everyone thought was a lock a few months ago.
People were very excited about SoFi.
But SoFi's market cap recently stalled and slipped just below that required $22.7 billion threshold. It really shows how unforgiving that math is.
Marvell is a perfect continuation of the AI industrial complex theme we were discussing. I mean, they provide custom silicon and interconnect solutions, the vital physical plumbing for AI data centers.
So if they swap SMCI for Marvell, the index stays heavy on AI infrastructure.
Yes. The committee keeps the index's AI infrastructure weighting high, but replaces a severe governance liability with a fundamentally stable operator. As for SoFi, it's a great lesson in the difference between retail sentiment and index mechanics.
Retail loves a good narrative.
They do. Retail investors love the stock and dominate social media chatter, but the S&P committee does not factor in Reddit threads. They care about that unadjusted market cap line. If you are a dollar short of $22.7 billion, the bouncer doesn't let you in.
It is ruthless. So let's zoom out from the individual winners and losers here. We have this massive AI-heavy reshuffling happening against a backdrop of crazy derivatives expiration. What does this mean for the broader S&P 500 benchmark for the remainder of 2026? What are the top brokerages actually predicting?
The consensus remains surprisingly bullish, but the spread of predictions is very wide. Top brokerages forecast the bull market will continue for a fourth straight year.
Driven by what, mostly?
A dual engine, really. The
Yeah.
continued momentum of this massive AI infrastructure build-out and anticipated interest rate cuts from the Federal Reserve. A recent Reuters poll projects the S&P 500 will rise nearly 12% to around 7,490 by year-end.
Okay, so pushing well past that 7,000 barrier.
Right. But you have BofA playing it highly conservative, targeting 7,100, while Oppenheimer sees the index soaring all the way to 8,100. Underlying all this optimism is a belief that global GDP will remain resilient, growing between 2.4% and 3.3%.
But they do note some dark clouds, right? Things like sticky inflation, valuations getting stretched incredibly thin, and geopolitical tariff tensions.
Always risks on the horizon, yeah.
So what does this all mean for you, the listener? If we see the S&P 500 actually hit that Oppenheimer target of 8,100 by the end of 2026, is it because the entire U.S. economy is booming? Or is it just because these newly added massive AI giants are violently dragging the other 490 companies across the finish line?
That requires critical thinking from anyone holding an index fund. Mechanical flows, forced buying from ETFs, and AI hype can absolutely push the market up in the short to medium term. But gravity always wins eventually.
Fundamentals have to matter at some point.
They do. Long-term sustainable market performance always reverts back to basic fundamentals. Real revenue growth, actual profitability, and durable competitive positioning. If the AI complex doesn't deliver the world-changing productivity gains it has promised, all the mechanical ETF flows in the world won't save the index from a harsh correction.
It's a sobering reminder. So to wrap up this deep dive, we've gone from the rigid, bouncer-like rules of the quarterly rebalance straight into the explosive triple-witching collision happening this March. We've watched the index physically swap out dating apps and department stores for the heavy machinery of the AI industrial complex.
A historic shift.
Truly, we've seen the dramatic real-time consequences of terrible governance with the SMCI smuggling scandal, and we've looked ahead to the bullish yet highly concentrated targets for the rest of 2026.
This raises an important question for you to mull over as you look at your own portfolio. If the famous index effect pop is largely being arbitraged away by Wall Street algorithms before you can even react, and if the S&P 500's strict rebalancing rules are continually purging traditional consumer staples and financials in favor of a highly concentrated AI infrastructure, are you actually getting the broad, diversified safety net you thought you were buying when you purchased a passive index fund? Or are you, without even realizing it, making a massive, highly concentrated bet on the future of artificial intelligence?
Something to definitely chew on next time you check that 7,000 ticker. Thanks for joining us on this deep dive. We'll catch you next time.
Take care, everyone. Keep questioning the mechanics.